Yeah, this earnings multiples, whatever. So that means you need a professional.
You do need a professional. Consult your broker, to discuss the options that you have. But if you're a long-term investor, you have two options during period of panic. You either use your excess cash to enter new positions, to rebalance your portfolio, or you just wait it out. You sit and you wait it out. For instance, in June 2014, before the onset of the global oil price crash, the oil share index was at around 39,000 points. Today, it's at 44,000 points. So if you had waited out the market cycle, you would still probably have a positive return on your portfolio. Although risk-adjusted and adjusted for opportunity cost, it should have been negative. But if you had waited out, you could possibly still have a positive portfolio today. So if you're a long-term investor, you have two options. Reinvest your excess cash or wait it out. But if you're a short-term investor and you have a shorter-term horizon and you can trade actively, that's the time for you to study technical indicators, relative strength, momentum, oscillators, etc. For you to find stocks that have, that presents attractive entry opportunity to outperform in the short term and for you to enter them. And further, because it's also very difficult for you to know whether you have reached the bottom. So if you are buying into stocks because they have attractive technical indicators, you must set a stop-loss order to ensure that even if you don't know where the bottom is, you're able to reduce the downside risk of your loss.
At a point, by setting the stop-loss. Because once you set that, it helps you get out before the roof comes down.
Correct.
On everybody's head.
Correct.
So that brings us to this very important, and you mentioned that much earlier, about what you call the herd instinct. It's a bit of called the animal instinct. If you watch the National Geo, or those of you who like the Animal Planet, watching those animals you see these animals in a groove, isn't it? In a flow of entering into, just going, but once one jumps into the water, and there are crocs all over the place. So that's what they call the herd instinct, the animal instinct that says, follow the crowd, if you want to put it in a layman's language. So there are two ways in which you can get hot here, and I want you to explain. Should I follow the crowd when everybody is panicked? Should I run? And when everybody is saying the party is sweet, boasting, come in there, the door is open, have a glass of champagne, should I join them? Well,
I will answer you with the quotes, with the commonly known quotes of Warren Buffett.
I know you're going to go back to that.
Yeah, he said, be fearful when others are greedy, and be greedy when others are fearful.
I know.
So while you are trying to chase the head, be very careful and wary of buying past returns. Always try to think forward. What's the upside potential going forward?
Investors tend to buy past returns, which was already in yesterday's newspapers or news, isn't it?
Correct.
Rather than buying into the future, they're buying into the past. Because by the time their friends tell them at the beer parlor, or at the lunch, or over a pepper soup joint, or in the church, wherever, or at the praying ground, that, oh, I made this, it's usually past tense. Because the guy is not going to tell him the first day. So I have made money 2 months ago. Then I'm just telling him now because it has materialized. By the time I'm telling you, it's already past return.
We don't want to lose out.
I don't want to lose out.
Investors suffer.
So I go take current money and invest in yesterday's returns.
You have to think much more about the future.
So when we say stock market, what is the price of a stock really? Is it the past, the present, or the future?
It's based on the future. That's why when we do valuation as analysts, we are usually more concerned about the forecast assumptions into the future. So when we do a discounted cash flow analysis, we are looking at forward earnings, profitability of a company to do our valuation. But luckily for us, I think the important thing to also note is that during periods of market pullbacks, rather than being so panicky, it's very important for an investor to ask the question that what's driving this market downturn? Is it a cyclical factor or a structural one? Would it have a long-term effect or is it just a short-term, profit-taking sentiment? So by and large, I would say that the recent downturn we are seeing in the market, exhibited by the 3.5% decline in the oil share index last week, is probably much more a cyclical factor. In terms of real fundamentals, not so much have changed. Global growth is still very strong, right? And it's not going to change.
So when they listen to me, they watch Channels television, and they see the red numbers, and they say, wow, here goes Boston again. the stock market is falling.
It's crashing.
And here I go with all the big terminologies of bloodletting or crisis or whatever. And that's not the time to
hit the panic button.
That's not the time to hit the red.
Not yet. First, you have to be deeply introspective and ask the question of what's the factor driving this decline? Is it a cyclical thing that's going to pass away after a short period of time? Or is it a structural thing that will last so much longer? But for us, what we are saying is that what's happening in the global markets currently, and particularly the Nigerian market, is still cyclically driven. You know, the initial fears about rising interest rates, we think is probably not so justified enough, because if you look at the real interest rates of most advanced central banks, it's still deeply negative. You still have inflation much more higher than the benchmark policy rate. So if you're entering a tightening cycle, typically what you should have is a positive real interest rate. So the whole panic might not be in the end justified. And this could be an opportunity, you know, for some investors who have been looking at some stocks that have very attractive fundamental, you know, to actually, you know, key into them.
But should I be, in our own Nigerian environment, should I be too fixated with inflation, headline inflation, and the MPR? How do I play these two into my portfolio? If I'm thinking of, well, the market is declining, how do I game these two major pillars in my investment horizon and decision?
I think for Nigeria, the two most important variables for you to watch out for, let me say 3 important variables to watch out for in the market this day. They are, number 1, oil prices, because it's a major anchor of both the business cycle as well as foreign exchange earnings, as well as the flexibility of the foreign exchange market and liquidity. You should be looking at crude oil production, particularly as we approach the election seasons, you know, where you usually have politically motivated attacks on oil installations. That's very important as well. And the third factor is the political season itself. You know, how volatile would the election cycle be? You know, typically in Nigeria, during election cycles, we usually have, and not just Nigeria, but most frontier markets indeed, you know, Kenya, South Africa, during periods of election or political crisis, we usually have, you know, poor return in asset markets. So those are the 3 key things for you to watch out for in Nigerian market.
For 2018?
For 2018. Oil prices, oil production, and the election cycle.
I'll remember those 3. I'm going to remember those. I'm going to write them somewhere. If you folks haven't written it, I've written it there. The market will always panic.
It's always panic.
And there's going to be a panic again. We're not sure whether this panic is over yet. It's Monday morning.
Yeah. But over the long term, what you should remember is that equity markets, typically, equity markets have a track record of usually recovering from market dips over the long term.
Don't panic, guys. Another handshake. Thank you very much. Omotola Abimbola, our investment analyst, one of the team at AfroInvest. And we're continuing this conversation after the break. We're going to look at this new pricing methodology. If you track the market over the last 2 weeks, today is Monday. It's 3 Mondays ago that the Nigerian Stock Exchange rolled out a new pricing methodology for price values, for par values, yes, and with the number of shares you need to move prices across A, B, and C. That's what we're discussing over the next 25 minutes as well. Stick around, we're right back into